Good afternoon everybody, and thank you for joining us for Money Talks with PlaneSaver. My name's Rachel and I'm joined today by Jason Blunden, Mortgage Broker and Director of Evolve Financial Solutions. Welcome Jason.
Good afternoon, thank you very much for having me.
No problem, thank you for being here. Would you like to tell everybody just a little bit about yourself before we get stuck in?
Yeah, so my name's Jason Blunden, I'm the Managing Director of Evolve Financial Solutions. We're whole of market mortgage brokers, which means we look around over 90 lenders and thousands of products to make sure we secure the right mortgages for our customers.
Excellent, thank you. So we've had a lot of members submitting questions ahead of today's event, so if it's okay with you, I'm just going to get stuck in.
Crack on.
Yeah, we'll start the grilling. Okay, so interest rate predictions for 2024-2025. Will we see interest rates continue to fall?
Okay, so yeah, most of the high street lenders at the moment are reducing their fixed rates. Some buy as little as 0.25%, some buy as almost as 1% to be fair, which is great news.
Yeah.
I think with inflation now starting to come under control, we're probably, according to the statistics and the economists, starting to see the base rate looking like it will come down this year. Some are suggesting it might be 3 cuts, some are suggesting it might be 4 cuts.
Right.
So with normal base rate cuts, that normally brings the fixed rate pricing down, which means we will pay lower for our mortgages. Which is
Great news.
Good news, absolutely right, good news.
Thank you. Okay, so what is the ideal score, so credit score, when you're applying for a mortgage?
Okay, really interesting question because most high street lenders will go by credit score and credit search, whereas there's some great building societies out there that look at mortgages as well that will just only credit search rather than score. Okay, so normally I would suggest the late 800s to 900s is going to be perfect, or excellent as it calls out to be, but it doesn't necessarily mean you can't get a mortgage or you can't get a decent rate. So actually, yes, if you like, 900, 999, you know, they're the brackets that people tend to say I must fall into that, but it doesn't define if you can or you can't get a mortgage. So there's plenty of choice out there, and again, we look around to make sure we find the right product for the providers, for the customers themselves.
Yeah. Okay, thank you. Next one. So, when buying a council property, are you expected to have a deposit?
No, actually. There are some big high street lenders out there, such as Halifax, that will look at the value of the property, look again at what you're earning, and look at how much you can afford, so how much you can borrow. So not necessarily so, do you need a deposit? It's right to buy, that type of thing, it's common as it's called now. Lots of choices, you know, again, some out there whether you haven't got the best credit history in the world, and some have got perfect. So again, it's just matching the right product for the right customer.
Interesting, okay. So at Evolve, do you deal with buy-to-let mortgages or residential mortgages only?
Both. Both, absolutely. Short, sharp answers to that one. But yeah, there's plenty of customers out there that have got properties at the moment that are let out, probably with deals coming to an end this year. There's plenty of customers out there with residential mortgages coming to an end as well. We look at both. And quite often, sometimes when people have got a property that actually has got quite a lot of equity in it, then want to move home but don't want to sell their existing property, they can often let out their existing property to buy a new one. So we help people through that process as well. So very similar to a buy-to-let mortgage, but it's a let to buy. So slightly different terms, but again can be done. We help with that as well as buy-to-let, as well as remortgage, as well as purchase. Plenty.
Okay. So next question.
Yeah.
What are the benefits of using a broker versus just going straight to the bank of your choice?
Okay. So if you went to this bank of your choice and they said no, what are you going to do?
Good question, Jason. I do not know.
Okay. The answer is by coming to us, we've got over 90 lenders to choose from. Okay, so that saves a lot of shoe leather, walk up and down the high street, different places, a lot of time on the internet, a lot of time on the phone calls. Okay, speaking to someone that's qualified, that's whole of market, will make sure they look at all the options there for you. Many years ago, I used to be a bank manager. Many years ago, it's hard to sell. Many years used to be a bank manager, and we only had one product range available to us. So if a client didn't fit that, we had to say no. And that's not something I enjoy doing. So hence I left the bank to then become someone that could say, actually, let me find you a way, let me find you a solution to your mortgage needs. And that's how we do it. So instead of just going to one, we go to many.
Okay, thank you. Okay, so how do you get a second mortgage when your first house was bought under the Help to Buy scheme?
Okay, so there's a couple of things you need to do first there. Help to Buy scheme was specifically in place for people to get onto the ladder, or at its early stages for people to move into new build property. As the Help to Buy years went on, it was only there for certain buyers buying certain houses, and a certain amount of equity was there by the government. But actually you can't, in real terms, unless you're in the forces. There's some small print there regarding the forces. But in real terms, the only way to do that is to effectively pay off the Help to Buy, either by a remortgage or if you've got a cash lump sum to pay that off. You can then look to approach your mortgage provider to see whether or not you can let that out with their permission, and then you can go and buy another property. Again, if affordability and deposit works, but you can't just basically go, well, I got that Help to Buy, I'm going to go and buy another. Okay, that's in the small print, and it's very clear in that small print as well.
Okay, thank you. So what's harder, Jason? A buy-to-let mortgage or a normal one?
Got all the questions today, haven't you?
You have, yeah.
Okay, so each come with their own different criteria.
Yeah.
Okay, each are for two different things. So I'll give an example. Everyday affordability for someone buying their own property, we need to look at income. It needs to be obviously a certain amount of deposit, and different criteria regarding job and time in the country. With a buy-to-let, sometimes there's no minimum income. It's all to do with rent, and it's all to do with term on mortgage and interest rate on mortgage at this moment in time, because the various different interest rates now, where they've crept up a bit more, have made it a little bit more tricky for buy-to-let mortgages to be granted, just because buy-to-let is based on the rental, a lot of it. Okay, so they're based on two different types of calculation, two types of criteria. But actually, for someone who's earning all right money, doing a good job, perhaps got their own resident, it's very straightforward, very simple to get a buy-to-let mortgage.
Okay. Is it always a minimum of 25% for a let-to-buy deposit?
For a let-to-buy deposit, 25%. Trying to think of ones at 80%. Mostly, I would say, without having all the criteria in front of me. And again, everyone's situation is different. There is a couple of providers out there. I can think of one actually that would do 80% on a buy-to-let let-to-buy mortgage. Again, down on rental, down on criteria, down on client circumstance. Without giving individual sort of financial advice at this moment in time, there is possibilities out there.
Okay, so this is a good question. How do I need to save to buy my home? So what would you say are your top 3 tips when somebody's starting that savings journey for that deposit? What are your top 3 tips?
Okay, so first things first, I think you need to set your stall out of where you're looking to buy. Speak to a qualified mortgage broker to understand what that cost is going to look like and what you need to get to. Then we need to look at things such as your spending habits. So very easily and very quickly, we drive through for a Costa, we drive through for Starbucks. We might join a gym at the start of January, and by February we might not be going. So all these things creep into your budget and start chipping away at what money you've got there that you could save up. So you want to be in a position where you can save as much of your money each month as you possibly can.
Okay? So really looking at your existing budget.
Look at your own budget now. But with a qualified mortgage broker sit in front of you, look at what budget you need to have available to ensure you can run that house where you want to be. Now, obviously, savings one thing, credit history is another. Okay, we touched on what credit levels people need, but it's really important to understand that, because you might save all the money in the world, you might just about know where you're going to buy, but actually find you can't buy it because there's something on your credit history. So it's worth understanding. Get a credit report from a number of agencies out there that will talk to you about, will show you how your credit score actually is. okay, and then you can look at the lenders to go with that. Equally, after saving, after looking at your budget, after looking at credit score, and obviously a bit of time, you're still not getting quite where you are. There's schemes out there, Generation Home for example, that will help you income boost and deposit boost, okay, through the help of family. Okay, so family can get involved. Family don't have to give you the money. It can be there as kind of a loan from family with the schemes available. And actually, if you're coming up, short financially on your multiples, your income multiples to buy where you want, then Generation Home have schemes where you can use some of the parents' income to actually boost your own to buy a property as well. So if you can't completely do it all on your own, but you have mum, dad, uncle, aunt, grandparents out there, brothers and sisters even, that could help you buy, you could bring them in to help you buy a property, and that can help actually put you in a good position.
So when we're thinking about that application process, say somebody's first...
Sometimes P60s are needed, because if we're talking about people's bonuses, the banks like to see that you've got a track record of them. So normally a couple of years of P60 is what's needed there as well. Bank statements, so we need to just look at people's spending habits, and what they're looking for on there is things that might not be conducive with having a mortgage. So we talk all about now sort of betting and gambling, which is obviously you've got to be aware of how much you're committed to, and there's obviously great things now in place to make gamblers be aware. But when you're looking at bank statements and there's lots going out, and it perhaps is creating someone to not have a lot of money left at the end of the month or overdrawn or beyond their limits, that would be a concern. So we need to look at that side of things as well. Banks are quite accommodating now for that side of things. If it's within tolerance, within inside limits, not creating you a financial problem, then they're fine with it. Okay, it's just having that moderation to it. So basically, bank statements, pay slips, P60s, and of course identification. So passport, driving licence, absolutely right. So if you come prepared with that, we can sit down, we can check your income, and then we can turn around and we can look at the array of banks out there and give an array of what banks will lend, what costings they will lend as well.
Thank you. Okay, so we've got a two-part question from someone here. Okay.
2 parts.
Bring it on. Okay, so I have a small mortgage that's on fixed term which ends in May. I don't particularly want to pay it off and I overpay most months. Would it make sense to go onto a tracker mortgage in the short term on the basis that rates will drop and then take advantage of lower rates when they appear hopefully lower towards the end of the year?
Okay, it's an interesting one. Again, without giving full advice on that, because the situation is different. There's a number of ways of doing that. Okay, so if they've got the money to pay it off, and obviously clearly that's going to save all interest. If they've got money they just want to chip away at it in larger sums, then again, whether you're on a fixed rate or a tracker rate, you have the ability to lump sums off. Some lenders are doing 1 year fixed rates, and fixed rates tend to be slightly cheaper than trackers as well. And 1 year fixed rates will come with again the 10% allowance. Okay, just one provider, Virgin Money, came out on Friday with actually a 5 year fixed rate, a low interest rate for that 5, but you're free to leave them after 2. Early redemption charges slipped away after 2, which was a really clever feature. So it brings down, at the moment 5 year fixed rates are cheaper than 2, so it gave you a lower interest rate, still with 10% a year you could pay off, and you could come away from it completely in 2 years' time. There's also another type of scheme that's actually an offset mortgage, which don't get sort of talked about too much these days. Now, an offset is if someone's got quite a lot in savings, but they've got a mortgage balance as well. If they had an offset mortgage, they could put the balance of their savings into an offset account alongside their mortgage, and that would stop them getting any credit interest, but it would stop them getting any debit interest as well on the amount that it's offsetting. So if you've got a £100,000 mortgage and 50,000 in savings, 50,000 against that 100,000 all of a sudden means you're paying half the interest you were on your mortgage. Okay, so there's several ways round of using that, and that can be really good for people that have got big bonuses that come in and actually don't want to spend it, but actually the interest rate they're getting on the savings isn't great, but it'll enable them to either reduce down the interest they pay or even reduce down the term of their mortgage by putting money in offset.
How would somebody go about getting financial support from the bank? And I think what this person might be referring to is something like a bridging loan to help them secure a mortgage.
Okay, so there's a couple of ways around that. They might be looking at, as you say, a bridging loan, but it might be the case of, if they're in financial difficulties, or it could be a number of things, really and truthfully. I think if they're looking to buy their next property and they need help from a bank to buy that, often people come to us and say, what do I need to enable me to buy that? So other than documents, we would run a decision in principle or an agreement in principle with a lender. That gives you a bit of paper that often when that person then goes to a estate agent or goes to a new build developer, they can say, look, I'm mortgage ready. I'm mortgage approved, this is my passport in real terms, this is my agreement to show that I can buy that property, and here's the money here that the bank's agreed to lend to them.
Are you ready for another long one, Jason?
Keep them coming. Keep them coming.
Okay, so I have a fair amount of unsecured debt on credit cards. Okay. My fixed rate is about to end in February, at the end of February. Do you have any suggestions with regards to paying off some or all of this by way of increasing the loan amount on the remortgage? Also, my existing mortgage will become on a variable rate of 9.5%. Should I fix now or move on to an interest-only option?
Crikey. Okay.
That's a lot.
That's a lot there. Okay, so there's two parts you say to that.
Yeah.
So credit card wise, it's important to know what the rates they're paying on those credit cards actually is.
Yeah.
Okay. Some are 0% sometimes, and some of them are obviously a higher rate than that.
Yeah.
It's also to say, look, if you're going to put short-term credit on a mortgage that's there for 20, 25, 30 years, actually overall you'll end up paying more interest on them over that longer term than just keeping it perhaps tight and short and maybe over a personal loan period of time. So it's worth just exploring that individually with a mortgage broker fully to make sure you're getting the right advice for that. Yes, there is a call for doing it. Lots of caveats, lots of make sures, and just to bear in mind everything to do with adding finance onto finance over a longer term. 9.5% for a mortgage, absolutely you can't leave where it is. Okay, depending on what the loan is to the value of the property. Most of the rates now, and again this is high street, standard mortgage criteria, standard credit criteria here, is probably 5% or lower.
Wow.
Bid 5%
massive
or lower.
Difference.
A massive difference. And actually we've got to think about there is actually if they're paying 9.5% on the mortgage and they could get their mortgage for say 5%, that frees actually up a lot of money per month that actually they could put towards paying off that short-term debt a lot quicker. And money management and balancing it right is probably the best way forward to look at there. So that's why I would say that person, make contact with us, no problem at all. We'll go through a detailed budget planning with them, make sure we understand all the debts involved, and look at the right options for that person. Really keen to help them, to be fair, because it sounds like the mortgage they're paying is literally far too high.
Okay, thank you. Next one. Any advice on how to pay off your mortgage earlier?
Okay, so there's a couple of things you can do there as well. One thing we said about earlier on was actually the overpays, because people that overpay on a regular basis are very much able to chip away at their balances and therefore bring down the interest they're paid. And the more they reduce down their balance, the more their monthly payment turns into reducing their capital rather than paying the interest. So it actually snowballs, goes through as well. Obviously another way around that is if you're looking at the offset, because actually if you've got more money and you can put it into a savings account, then all of a sudden that alongside it again brings down your debit interest and also means you can have more money paid off your balance. So a combination of those is really good. It doesn't matter if it's a small amount, £50, £100 or lump sums, most will allow you to overpay by sort of up to 10% a year of your balance, and that's in the calendar year. From the mortgage started normally, so lots of flexibility. But certainly, if you think it's only a small amount, it chips away. So definitely worth doing.
Fantastic. Okay. Next one. I'm 60 years old. Can I get a mortgage, and how much of a deposit should I have if the house price I'm looking at is around 250,000?
Okay, so yes, you can get a mortgage.
That is
Okay,
good news.
absolutely right. 60 years old, no problem at all with that. It comes down to how long you want the mortgage for.
For sure. Yeah.
Okay. Now you need to have a mortgage term for at least 5 years.
Mhm.
That's what the most high street lenders are. Quite a lot of them will now let you go to age 75, 70, 75, even up to age 80.
Wow.
What you've got to look at is how you can afford it
Yeah.
later in life. Okay, because
Yeah.
if we stretch the mortgage term past standard retirement age,
Yeah.
which varies depending on the date of birth, then we're going to look at 70, 75 as pushing in past retirement.
Mm.
Now, if you're making a pension contribution now, it comes off your pay slips,
Mm.
you'll have some pension there.
Yeah.
So what does that look like? Or can you guarantee you'll be working to that age as well? And obviously you'll have the full salary. So we've got to juggle
Yeah.
it around a little bit. Because obviously if it's a 5 or a 10-year term only to a mortgage, the payment's going to be a lot higher because you're trying to pay off an amount over a short
Yeah.
period of time.
Yeah. No, that makes sense.
And the bank's affordabilities are then based on, yes, your income,
Mm.
but also what your outgoings are, and obviously then leaves a little bit of a gap then to what mortgage payments they would be happy with
Yeah.
as well. Maybe 5%, 10% deposit, you know, you can still get away with at 60, it's not ageist. You know, you can still do that,
Yeah.
you know, it's not a problem at all. It's down to affordability, it's down to a rounded conversation.
Yeah.
But all of the above is a yes, just got to balance it just right.
Yeah. Okay. So what, if any, are the benefits for first-time buyers?
Loads of benefits.
Hit us with them.
Absolutely loads of benefits. Crikey, where do I start? Okay, so you're getting on the housing ladder now. It's deemed to say that house prices have dropped a little bit,
Mhm.
okay, or corrected a little bit, should we say, and different parts of the country have had different corrections.
Okay.
All right. Now, as we said earlier, rates are starting to come down.
Yeah.
Rates are starting to come down, which means affordability for people is starting to be more like it. Okay, oh, I can afford it now. Or the headlines say that rates are a little bit cheaper, so I can go out there and I can buy a property. Okay, so that brings people more interested out there into the marketplace.
Yeah.
Which means all of a sudden, demand for properties starts to pick up. And when demand picks up, obviously they think, actually, hang on a second, I don't need to correct this price anymore. I can keep it where it is. So actually demand is quite good, I might be able to push the price up. So no one knows where that bottom-ish will be,
Yeah.
but certainly based on where we are now with prices, yes, now's a good time to buy. There's never going to be a point where you go, oh, do you know what, Tuesday next week, about 20 past 12, it's going to be the right time to buy.
Why not, Jason?
Why not? Well, absolutely. But actually, you know, you've got shared ownership as great examples out there and a clever way of buying right now.
Yeah.
You've got, say, other schemes, Right to Buy mentioned earlier.
Yeah.
You've got discounted mortgage schemes. You've got first home schemes, and the banks back in mortgage guarantee at 95%. So there's a lot of help out there now to help buyers get on the ladder, and first time buyers again with Gen H, like I was suggesting earlier on,
Yeah.
with regards to banking mum and dad, and they're a big player in the mortgage market as well.
Yeah. Thank you. You mentioned shared ownership, because
Yeah.
this next question is
Perfect
about just
timing,
that.
I'd
I
say.
know. So someone's asked the question, is now a good time to buy my first home under a shared ownership scheme?
Yeah.
And is it best to wait a few months?
Okay, so shared ownership.
Yeah.
I think the best way to describe that is a clever way of buying right now. Okay, because you know if you're thinking, was just saying about mortgage rates earlier, maybe 5.5. For someone on 9.5, that seems really good.
Yes.
Okay, obviously go back maybe 12 months, rates were like 2.
Yeah.
You know, 2.5, that sort of level. So they're not as low as they are then. However, then if mortgage rates were 2.5, the average rent on a shared ownership is 2.75%. Okay, so when you got mortgages at 2 and a bit, and you got rent at 2.75, it makes sense to do a lot of mortgage because it's cheaper than the rent.
Yeah.
Okay, simple maths.
Yeah.
But when you're looking at shared ownership now, if you've got mortgage rates at 5 and a bit, and the rent's 2.75, then actually it brings your whole payment down, because if you've got 50%, buying 50% share, with a mortgage at 5% and 50% on rent at 2.75, which is just rent, not paying back the capital, your overall monthly payment will be lower than if you took on a mortgage 100% or 95% at a rate of 5.
Yeah.
Okay, but the clever bit about it is most shared ownerships almost all shared ownships, will allow you to what's called staircase. So you can buy more of the rental share out. So actually, over the period of time, you could buy that other 50% on a mortgage as time goes on. So as rates come down, so maybe they're 5% now, they might come down to 3, 4, 4, 3.5, hopefully, over the next 12 months.
Yeah.
When rates come down like that and your mortgage comes up for renewal, you can buy more of the rental share.
Yeah.
Okay, so own more of the property at a time that suits you, rather than all now.
Yeah.
So I think it's turned a corner over the last few years, shared ownership, to be a really clever way of buying and an affordable way of buying, and certainly a great tool at this moment in time for people to buy.
Okay, thank you.
You're welcome.
Okay, so next one. What options do you have in terms of getting a mortgage if you have a default on your credit report?
Okay, it depends on default.
Yeah.
Depends on size of default.
Yeah.
Depends how long you've had it for, and depends on if you've paid it off or not. Okay, so
Yeah.
lots and lots and lots of different bits and pieces there to consider. Again, it's one of those ones where I'm careful not to give advice at this moment in time, but equally to explain there are lots of options out there.
Yeah.
Okay. Normally people think when they have got a default or a CCJ or a bankruptcy that actually you can't get a mortgage, and it's down to each person.
Yeah.
It's down to granular detail, which we just talked about there briefly. It is very possible to get a mortgage. Even some high street providers out there will look at this and go, that's not a problem, depending on how long you've had it for.
Yeah.
Others, if it's like a communications default, things like that, aren't taken into consideration sometimes. So there's lots of ways around that. Again, sitting down with someone with your credit report.
Yeah.
I refer to it as a storybook, actually, of your financial affairs.
Tell
me a story. Let's read the storybook of your financial affairs. It's very clear.
Yeah.
It shows a black mark against something that's not really where we want it to be.
Yeah.
Or it shows a high number where we don't want it to be as well.
Yeah.
So if we read that, rather than hit your credit history or credit score so many times for different searches, we know straight away what you can and what you can't do.
Yeah. Yeah. So important to have that initial discussion.
Absolutely right. Yeah. All that.
Okay. So what is the actual process, including costs and other professionals involved, when buying a home for the first time that someone should be aware of?
Okay. Process is really, as we spoke about, the saving side, is to understand what you can borrow.
Yeah.
Okay. We do have great conversations with every client. Sometimes I probably don't give them the great news they're hoping for because they set their sights on something that actually their heart was involved, should we say, before their head was actually in the point of knowing the sums.
Yeah.
So I like to get the head lined up before the heart goes out and gets really involved with a particular property.
Yeah.
So we need to understand their mortgageability to start off with. All the details of getting the pay slips, P60s, all of that to start off with. The process is we would then look at it, we would then get their mortgage approved in principle.
Yeah.
Alright, which generally is a credit score, a credit search on the history, with the income side of things to one side, to give them that document to show that they are there in a position to have a mortgage passport, if you like. They'll be looking at new build developments, they'll be looking at shared ownership providers, they'll be looking at estate agents, what properties in their chosen area they can obviously afford based on the mortgage passport, if you like. But other professionals would be people like solicitors, conveyancers. Would say an average conveyancing cost probably between £1,200 and £1,500 for someone, and their job is to make sure legally that house can be purchased that you want to buy, and that everything is correct and in order for you to buy that property. Okay. You've got surveyors, which might be needed. With new build properties, not often do we need to get a more detailed survey involved, but when you're looking at a property that's pre-loved, should we say?
I like that.
Yeah, perfect. A house that's been lived in before. Depending on how old it is, we want to know a little bit more about the fabric that's been made, any defaults you might have, and you can get full structurals or home buyer surveys that would actually understand a little bit more about the makeup of that property and if it's going to cost you money once you've moved in.
That's
if you don't get it searched before, if you don't get it looked at, and you think, you know, what's a fabulous house, this Victorian house, 200 years old, nothing's be wrong with it, you might be surprised. And forewarned is forearmed.
Yeah.
So making sure you go in knowing, actually I'm buying it with this much money, got nothing left. If something's wrong with it and it's going to cost you money,
Yeah.
where are you going to
Where
be?
do you go from there? Yeah.
All right. So surveyors buying a pre-loved house
Mm.
is really important.
Mm. Okay. So next one, I'm interested in getting a mortgage. Great news.
Absolutely.
Who is the best mortgage advisor for us cabin crew?
Me?
It's
It's going to be me. It's going to be me.
Oh, okay.
Absolutely right. Absolutely right. You look at them. We understand cabin crew really well, actually. I've seen many of their payslips over the years.
Yeah.
We know there's lots and lots and lots of different lines and entries
Yes,
on cabin
there
crew.
are.
There's a variety of payments, there's commissions, there's bonuses, there's travel time, there's layoffs, all of these things that are on there. So really important to get an accurate guide to what they can afford.
Yeah.
So we ask for the payslips.
Yeah.
Okay. Weekly, 12 weeks, monthly, 3 months. We might then look at 2 years worth of P60 as well, because it might be they've just had a bit of time out
Yeah.
over the last 6 to 8 weeks.
Yeah.
So it's good to consider what the track record has been. But yeah, very familiar with cabin crew, pilots,
News.
and so on, to be fair. So yeah, and you know, normally the way we can work their income is to the right level that they're happy to pay as well.
Yeah.
Because sometimes they're like, well, I can afford more than that, my rent is this.
Yeah.
You know, and that's a big thing at the moment. Rents have gone up a huge amount.
Yes.
But actually we can find a way of them buying. But on the face of it, sometimes they say, my basic's this. There's plenty of other bits on there that we can add to it as well.
Okay. My mortgage is ending this year and I need to take another mortgage.
Okay.
Are the rates decreasing? Would a short term or a longer term be better? Also, I would be potentially looking to add a little bit more onto the mortgage. I'm going to maybe assume that might be for something else other than the house itself.
It could be for, you know, quite often people looking to extend. If they can't afford to buy the next property, that's out of their reach. If they've had a good chat, think, you know what, I can't afford this, then often to extend is another way, and it can add value to their property there as well. And often people do that to remortgage or do a further advance, and we can certainly help them through that as well. I think the first point, whether it's 1 year or 2 year, is again down to that initial conversation with the customer. Rates are coming down. You know, short-term fixed rates are coming down. 5-year rates are a little bit lower at the moment than short-term, which gives you, I'm being told, the economists say that shows that this is coming towards the end and there's a shorter blip than maybe people thought. I will stress again though, it comes down to a one-on-one, a couple having a conversation with me, and we can talk about, you know, their lifestyle, their family if they've got it, their needs, what they're trying to achieve, and take them along that journey. It's really important, I feel, people talk to people, and it's good to drive a relationship forward, and to understand what the needs are going to be, because it might be to plan just not only now but also in a few years' time. Because if they need maybe a further release for extra building work in the future, it's good to build that in at this stage as well.
Okay, thank you. Next one. Are there any lifetime mortgages? I'm 66 and I need to remortgage in 4 years' time.
Okay. In answer, yes, there is. Okay, so lifetime mortgages is an interesting mortgage scheme at this moment in time. I think what the person's getting to there is a mortgage for the rest of my life. And that can be described in a couple of ways. There are lenders out there that will allow you to go 80, 90 and beyond on a normal mortgage. On those simple building sizes will do that. There are some providers that say actually, or some customers say to me, look, I'm 66, I'm not going to clear on mortgage, I'm going to end up with this home, I can't afford to pay it off completely, but I want to stay in my property. And that refers to a lifetime mortgage like an equity release. Okay, so the old-fashioned term for it was equity release, still what they can be referred to, absolutely right. But that nowadays they've been innovated. They're a lot more adaptable, a lot lower rates, a lot more flexible than they've ever been before. They can perhaps at that moment in time, you know, replace a standard mortgage for that particular person. That would mean actually, if they were no longer earning the money they need to pay that mortgage, interest could accumulate, could roll up. Or it could be that the clients don't longer earn the right amount of money, but they want to pay some. So these new lifetime mortgages, you can pay some towards as well, and you can make some ad hoc lump sums as well. So yes, there is lifetime mortgages. Yes, it can help their situation now, but also in the future. And they're a lot different. They're there for maybe for a mortgage of choice for more senior years,
Yeah.
to help them still live in the place they want to, or buy somewhere they want to as well.
Thank you. How many years does it take for a non-UK resident to apply for a mortgage?
Okay, so this can vary on income
Mm.
and visa status. Okay, so it's really important, again on this one, without committing myself to advice,
Of course.
to examine all of that before we can give such information.
Yeah.
There are some providers out there now that you might do it from a year, depending on salary, depending on skill visa type.
Yeah.
There's some that's at least 2 years.
Yeah.
There's some with loan to values, you can only borrow 75%, some will go up to 90% at 2 years. We review each one. It's a particularly niche that we're getting quite involved with. A number of our brokers around the country are in areas where visa's really important for the workforce there,
Yeah.
and actually we're trying to help more and more and more find a way around these people to help them buy. And in fact, last week Halifax was one of those providers that reduced their criteria, changed their criteria for the benefit of people that hold visas as well. So again, each one's individual.
Yeah.
Each one's worthwhile having a great conversation with, and we've certainly helped a lot of people. Just last week I was helping one particular client in Kent to buy a property and a visa, so yeah.
Okay, fantastic. If you're struggling to save for a deposit, what's the best way to plan to get a mortgage?
Okay, so probably comes back to a lot of what we were talking about earlier. The planning and preparation to do with ensuring that you know what your budget is now,
Yeah.
but what your budget would be going further forward as well.
Yeah.
Are you expecting a pay rise?
Yeah.
Are you looking to change career? Are you sort of in a role where you think, do you know what, I might go self-employed? You know, all these things to be considered, because as a self-employed person, it takes probably a couple of years is best of accounts and books
Yeah.
behind you to go
Yeah.
forward. As employed, we could do it even sometimes on a job contract. So, you know, are you earning the right amount of money you want to buy where you can? Again, credit history,
Yeah.
savings, lifestyle, all of those to get yourself mortgage ready.
What about things like 100% mortgages, is that a thing?
There was there is a Skipton product out there that was along those lines, but the criteria behind it, small print behind it, was based on if you've been renting, and if you've been renting in the last 6 months,
Yeah.
and the rent are related to what you could afford. So again, it was each individual person.
Yeah.
I would say in a lot of situations we looked at it and it didn't work, and I
Yeah.
think that's been the general consensus of it. But there is a product there. There is a product out there, and if it will work, we'll certainly find a way to help people do that. So I'd say at the moment 95% mortgages are out there,
Yeah.
very much so. I'd also say with some smaller lenders, you've got a situation where actually maybe not all of your 5% has to be your own money. There are providers out there that will let you borrow a little bit towards that as well.
Okay, thank you. When do you feel interest rates might begin to lower? I know you touched on this earlier.
I think there's a little bit of a blip with the inflation just dotted upwards slightly. It's quite interesting, isn't it? Because you know, we need to go out and spend money. Certainly Christmas. I think I went home with no present for my wife just because I said, look, rather inflation's, you know, it means I can't spend this Christmas.
Not the best
Don't think she'll be overly happy. So I think we've got to bear that in mind for the end of year and a bit of spending. And I think that's obviously had a bit of an impact. It was bound to. I think we'll start to see, you know, petrol prices have come down. That's less money we're spending out of our pockets. I think energy costs will start to come down again. And obviously mortgage costs from fixed rate providers you know, banks are coming down as well. So I think we'll see base rate cuts, hopefully not too distant future, probably somewhere in Q2 this year I would suspect, and then to nudge down a bit further. So no one's got a crystal ball, but all the writings on the wall that it will start to go down more and more this year. So it's important. We talk to our customers not about today and about tomorrow, but it's about talking to them as the days and the weeks and the months, and keeping in contact is a big thing that we do. And as soon as what we can afford versus what we want to afford crosses over, then we can take further that conversation. And it just means that they're in a good position then to buy.
Okay, thank you. Can a person who has had a bankruptcy but been discharged get a mortgage? And if you're over 50 years old, can you get a mortgage, and under what sort of conditions?
Over 50 years old.
Over 50 years old.
I hope so. I'm not giving anything away there, well I hope so, alright. Over 50, definitely, 100%, no problem at all with that. Bankruptcy, yes you can. Okay, there's again, depends how long you've had it, depends when it was registered, depends how much it was for. Each provider is very different, but there's some fantastic providers out there now that, like Bluestone and Pepper Money and various likes like that will help those situations. And if it's been long enough, the high street will take a view on it as well. And actually some fintech digital mortgage companies out there are quite keen to have those discussions with us, and will take a view. So yes you can, and yes you can.
I like those answers.
There you go, especially over 50, crikey.
I know. Okay, so that leads us nicely into the next question. So someone has asked, what's the maximum age to be able to apply for a mortgage?
Okay, so think about it carefully really. State retirement age is dependent on obviously how long you're paying for, the age you're born, blah blah blah. So a barometer is you've got to have a 5-year term as a minimum mortgage, and normally it has to finish by state retirement age. Okay, normally. But again, sitting down and understanding what pension provision you got, could you work on? Could you go to age 80? Could you go to age 75? All of that is what you can then build in to maybe advice and recommendations to do with someone that can borrow past that age. Okay. So 5 years is a minimum term. Certainly that's what you've got to bear in mind. But yeah, you could borrow past the age of 67, 70, but it's down to each individual person.
So again, you'd need to have that conversation. Okay. All right. What are the current measures, used to decide on how much to lend to a first-time buyer? So, for example, is it just income and affordability, credit score, etc.?
It's all of that.
All of that.
God, you learn so much.
Any more?
I know. You're
I'm done.
doing really well. Okay, so yes, so it's how much they earn. Okay, they might lend 4, 4.5, 5, up to 5.5, maybe a little bit more than that as well. Some providers. What we've got to bear in mind is if a young person comes to us and are on £30,000 as salary, there'll be certain multiples generically out there. But when we're considering if they can buy this property, if it's one person on 30,000, they can borrow so much. But actually they've got the council tax themselves, they've got the water rates, they've got all that. So it might not be in the end 4.5, 5 times income. It might be slightly reduced just because they've got all of those extra costs to go with it as well. If there's two buying together, yes, they can afford obviously slightly more because they've got a combined income, but it's also a combined income to cover more of those periphery costs there as well. So actually they might be more inclined to borrow 5 times or 4.5 to 5 times, whereas they might perhaps restrict someone on their own, maybe at 4. So affordability is a big thing. And each bank's got its own different affordability calculator, and we work on that each time. So yes, affordability. A deposit, some like NatWest, sometimes you can borrow more money than more deposit that you put in as well. So that comes into it. So it's really deposit, income, affordability side of things, credit score.
We're almost at the end of the first part of your grilling. Okay. So how do I know if I'm eligible to even apply for a mortgage?
Okay, that's going back to that passport. Alright, so I call it a passport, it's like an agreement in principle, decision in principle. As long as you've checked your income, we're putting the right figures in. Okay. Often people say to me, sorry Jason, I do earn £50,000 a year, it's definitely what I am, it's all basic salary. I say, that's great, love to see your pay slips. So just to make sure, they go, no, it's definitely 50,000, pay slips come in, and it's like a 30,000 basic and the rest is overtime. But because you know, we've got to remember that people assume that because they're always getting that,
Yeah,
that's
sure.
what their basic will be,
Yeah,
because they're used to earning that overtime as well as a basic salary.
Yeah.
But lenders look at overtime differently that they look at basic salary.
Okay.
And some lenders will look at using 100%
Yeah.
because if they see a consistent overtime, and some will maybe use 50-60% of it.
Okay.
All right.
That's good to know.
So absolutely.
Yeah.
So we'll just look at the balance between the two there,
Yeah.
and then work out the income from there. But using that passport will then show that we're in a really good position to buy afterwards.
Okay. I'd like to ask about buying mortgages with shared ownerships. I think buying a property.
Yeah.
Yeah, through shared ownership.
Very clever.
How does it work? And why can it be sometimes so difficult?
Right, I think this, you know, we spoke earlier on about shared ownerships being perhaps a few years ago, someone, oh, do I have to buy shared ownership, do I have to do this? It's not as good as buying my own property.
Yeah.
I think then it used to be more difficult. I've had some fantastic conversations with Leeds, Kent Reliance, with Halifax recently about all their work that they're doing in the shared ownership space.
Okay.
There's a huge amount of properties now in new build that are shared ownership that perhaps you would never have thought would have been shared ownership before.
Yeah.
More and more providers coming out there for shared ownership only developments as well. It's recognised now as I said earlier, a really clever way, but you know, it's affordable, an affordable way of someone buying their property. So actually, shared ownership then compared to where shared ownership is now is completely chalk and cheese. You know, so I think people will be surprised if they had a conversation now about what they can afford to buy. And in certain parts of the country, you know, it's probably going to be an even better way than buying than maybe not, or just sticking to renting. Because actually, you know, properties in London, maybe properties in some city centres there, if they're offering shared ownership schemes, it's a way of them getting onto that ladder. And they might be at the early stages of the career where they know that the salaries will improve as they go through. And actually at those times then they can staircase and buy out more, but they've bought in at the value now. Alright, so they're buying the value now, and yes, you know, value will increase over time, and the more shares they buy, you know, they've got to buy that at that value then, but it's a good way of buying. It's a really an opportunist time to do that. And I say, with the way that rates are now, it gives good scope to buy it, start on that ladder, and then buy more of the shares as time goes on.
Okay. I'm 67. I have a £200,000 interest-only mortgage.
Okay.
My home would be currently valued at around 600,000.
Okay.
My existing agreement finishes next year.
Yep.
Do I have any options other than to sell up and use the equity to move, which I would prefer not to do?
Okay, so there's a lot of equity in that particular property. So there's lots of choices. Obviously the first choice is, as the lady doesn't want to do, is obviously sell and move and downsize. If they're happy and content where they live in the property, we touched on earlier on lifetime mortgages.
Yes.
And actually sometimes these people are referred to as mortgage prisoners, where they're coming to the end of a time, mortgage up for renewal, they've got an interest-only mortgage, the way that they were going to repay it might not have worked out, their investments might not have worked, the bequest they thought they were going to get might not have worked, maybe the bonuses they thought might not have worked as well. So actually, what do I do about that? Lifetime mortgages come in then. You know, if they are continuing to work for a period of time, we can look at extending or using another mortgage provider if income allows to get them another mortgage through to when they actually are going to finish working. Maybe consider with that mortgage some element of repayment, so it starts reducing down that capital balance over the next few years. And if they get to a point where actually their income isn't going to be enough, or they are going to stop full-time employment, and they just can't afford to do that, then we can look again at the lifetime mortgages where releasing equity or having that where actually they don't need to pay off that balance, the interest can just accrue. That does take real specialist conversations. often involving family, because it can have an impact.
Sure,
200,000 now with interest just rolling up rather than being paid off will
Yeah.
accumulate to be quite an amount of money over the years.
Yeah.
So again, without giving advice there, it's a rounded conversation.
Yeah.
It's having awareness. There's lots of documentation there to make sure that clients are aware of what their options are. I say my preferred choice would be, if they're going to continue to work, can we help them find a mortgage that will last them a few more years, so they're servicing that interest, paying off the interest at very least, hopefully chipping away if they can.
Yeah.
But really worst case scenario is then perhaps doing a lifetime mortgage.
Okay. That concludes that part of the grilling.
Wow.
Yeah. So just want to see if we've had any questions in from the audience. No? Fantastic. You know what that means? You answered everything.
Wow.
Yeah. Well done.
That's incredible, isn't it? I'm surprised I knew that much sometimes. Surprised it all comes back.
Yeah,
It's good.
yeah. So thank you,
That's all
Jason,
right.
for
No
joining
problem at all.
us. That's been really interesting, even for myself personally. So we will, of course, share information with everybody who tuned in and everyone that's watching this on demand,
Yeah.
so that they know how that they can get in touch with yourselves
Absolutely right.
at Evolve. But thank you.
No problem at all. Thank you very much for having me.
Thanks, Jason.